Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the Wealthy Behavior Podcast, I welcome back Heritage Financial's Chief Planning Officer, Ed Jastrem, to talk about a topic that at least I feel, and I'm curious if he agrees, is a very important financial planning topic that is probably going either underreported or not enough attention is being paid to it. But let's not get ahead of ourselves. Welcome back to Wealthy Behavior, Ed.
Thanks for having me, Sammy. I'm happy to join you and talk about the Tax Cut and Jobs Act today.
Yes, otherwise known as the Trump tax cuts from 2017. And no, this is not a financial planning history class. The reason why we're bringing it up is these tax cuts, this tax package is set to sunset at the end of 2025, which means what, essentially, Ed? What is a sunset 2025? What does that mean for 2026 and beyond?
Yeah, that's the big question. So the way it stands right now, the tax laws that a lot of us have been used to now for a while, that will have been in effect for 8 years, will revert back to the way they used to be in 2017, starting in 2026. So, like you said, what does that even mean? 8 years is a while to change your habits, to set different expectations about your taxes. If you were graduating college around 2017, you'd be almost 30 years old now. If you were entering high school back then, you'd be finishing college. So that's a lot of time to forget what your tax situation might have been like some 8 years ago. The big pieces of this that will impact a lot of taxpayers, if you don't remember what happened when this law became into effect, is that the standard deduction increased substantially, tax rates went down, and a lot of people that itemized deductions and were able to take their state income taxes and their property taxes as a deduction were limited to only taking 10 grand, whereas in other instances that could be a lot higher. There's many, many more parts of the law, but I think those are the big ones that a lot of people will see change. What I'm expecting is that people might need to change their habits and change their expectations about what information they keep during the tax year, what information they share with their tax accountant. And if this does sunset and go back to the way it was in 2017, most people will probably face at least a modest tax increase.
Yeah, and so that's the thing that I think is important to focus on before maybe moving over to the other aspects of the bill, most notably the estate and gift tax provisions. But I've seen those estimates that this will be a overall tax increase, a revenue enhancer, so to speak. When you think about that, there's a tendency for people to kind of, I don't know, procrastinate with thinking through some of this stuff because I think Congress will do something in the interim and either not let it sunset or take bits and pieces of it and put it into a new tax bill. So let's attack that first. That's always a possibility, but have we seen anything that has been proposed, and not just proposed on a campaign stop, but any legislation making its way through to have something else happen besides the tax break sunsetting?
There's a lot of bits and pieces right now, I think is the best way to describe it. So you kind of mentioned, campaign trail rhetoric, and I think that's probably what we'll be hearing the most of, certainly in the near term, and that might be more of a distraction than anything else. But if you kind of dig into it a little bit, there's a few ways it could go, right? There could be a blanket extension. There could be an agreement that just letting these lapse and having the populace at large face a tax increase could be hurtful, and therefore we're going to push this whole thing forward, and there won't be a sunset in 2026. It'll be sometime in the future. Another way of thinking is someone's going to want to put their stamp, their mark on a new piece of legislation. So maybe in effect, it will be an extension of the tax cuts, but it will be called something else. It'll have a different name. The provisions might be a little bit different under the hood, but largely the same. A kind of third track is sunset occurs. It's not replaced with anything else, but some bits and pieces of it are pushed forward to help specific types of people, specific constituencies. So an example of that might be the child tax credit is enhanced and continued longer under the mantra of it, helping families and providing a tax break to people with children. So those are kind of the three broad paths it could take. I don't know right now where my confidence stands in any one of those. So I think our best bet as planners and working with our clients, what I'm proposing over the next, 18 months or so is now's a really good time to try to get a little bit better sense of what your taxes are telling you, even without digging into the finer details of the Tax Cut and Jobs Act. If you haven't paused to ever look at your tax return or to ask your heritage advisor or your tax advisor where you're saving on taxes, where you're getting hurt on taxes, are you doing everything that you can with your employer benefits? Is there something that a heritage advisor has suggested you do that you haven't followed up on? Now's a good time to kind of revisit all of those things. And I'm not suggesting that everyone become a tax law expert or understand how their taxes are calculated, but I am suggesting that it's a good time to get a better sense of where are your tax strengths and weaknesses so that no matter what happens, you'll be better prepared to at least think strategically about yourself and what your situation is.
So let's say the Tax Act sunsets, and you alluded to in your introductory comments some behavior changes, keeping track of things that you're, otherwise haven't had to keep track of. I'm assuming you're talking mostly about your itemized deductions, because we've seen a lot of people haven't kept enough track of what their deductions are because they know that they're going to take the standard deduction, and sometimes that information is even just missing from the tax preparing documents or missing from the tax return.
That's exactly it, Sammy.
Okay.
You're on point. That's largely what I'm getting at. I would say that prior to the law going into effect, so 2017 and earlier, the vast majority of our clients and people that came to us for advice about their savings plans and retirement plans and investments were all itemizing. It was extremely rare for me to see someone who was taking just the standard deduction.
Yep.
So if you think about what you could itemize back then, your state taxes that you paid, your property taxes, potentially some medical expenses, your mortgage interest, your charitable deductions, potentially the fees that you paid to your accountant to do your taxes, potentially our fee as an investment management fee, and several other miscellaneous deductions. Most of the clients we work with had enough of those things, and the standard deduction was low enough that they're itemizing. That really flipped pretty dramatically in 2018, where instead of it being something like 9 out of 10 people taking itemized deductions, it's now more like 50-50. Because of all the changes, it really limited that use. So from 2018 forward, if you're in that camp that has no longer been itemizing, you might just not be in the habit of keeping track of all your charitable gifts anymore. You might not be thinking about the mortgage interest or the investment management fees or other deductions that you might be able to take that you haven't been for a while. So that's just, like I said, the kind of habits, the record keeping, knowing what information is actually going to be used in your return. I'd say there's one other aspect of that that, again, is one of these things that's important to think about, even if we're not focused on the Tax Cut and Jobs Act, is there's been a number of rule changes at the state level. There's been a number of laws that came into effect during COVID after the Tax Cut and Jobs Act that modified other parts of tax and retirement planning. So it's always a good idea to stay on top of what's happening and don't assume that just because you didn't use something or take advantage of something in one year that you won't the next. I'll give you one specific example. For the people who are not necessarily able to itemize their charitable gifts anymore on their federal returns because they're taking the standard deduction, a rule went into effect for Massachusetts taxpayers where on your Massachusetts return, regardless of what you do on the Fed, you can get a deduction on your Mass return for your charitable gifts. That's new. So imagine you got into the habit over the last few years of not paying attention to a few hundred or a few $1,000s of charitable gifts because you realized that you weren't getting the deduction on your federal return. It didn't matter anymore. And you just didn't do anything with that information. If that's a habit you got into and you didn't use that info on your state return, you lost out on a state deduction. So there's more to the interrelationship with all these rules where, as I said, just don't assume that it's always the same. Just don't assume that because it didn't happen one year, it'll happen the next year, for better or worse. So it's important to kind of ask the right questions and be aware of information that we're sharing as advisors with these type of things, because it could be basically free money back in your pocket if you're not getting the right info to the right people.
Yep, absolutely. Well said. And as we pivot to the estate and gift tax exemption amount changes, that's something also that I feel requires some planning, or requires some planning to do maybe sooner rather than later, because some of the ways to attack the fact that the estate and gift tax exemption amounts could be decreasing substantially will take some time to put in place, and you'll be comparing a lot of different options. But maybe before digging into that, can you give our listeners the details on where we are and where it could be going to, and why there's this planning conversation happening?
I would love to dig into that because it is, like you said, if you wait too long on this one, it will be very hard to take any action. And I'll explain why. Separate from the income tax changes in this major law, one of the items that got a lot of attention was an estate tax change at the federal level. At that time, when the law was passed in late 2017, going into 2018, it effectively doubled the federal estate tax exemption, meaning the amount that you could leave to your heirs or that you could gift during your lifetime without any federal gift or estate tax. And that was really quite an exceptional benefit for higher net worth individuals. If they've passed away or made major gifts during this time, they've potentially saved, potentially wiped out their estate tax that would have been due prior to 2017, or had major savings. But if and when the sunset occurs at the end of 2025, those much higher exemptions will be cut back in half to what they were before. And what this has created is effectively a use it or lose it window. If you have a very large estate and you want to try to minimize federal estate taxes that might apply at your death sometime in the future, and the sunset occurs and you haven't done anything before then, you might have permanently lost a window to transfer money to an entity like a trust or to other individuals via gifts that could have captured the higher exemption. The big reason that you and I are talking about this as an issue that needs time is if you think about what it takes to move your estate around, to take advantage of this. If you're a high net worth individual and you have, for example, businesses, illiquid assets, special investments that are limited partnerships, property in multiple states, things that might require appraisals, things that might require change of ownership structure, things that might require board approval from a company.
Or psychologically, things that would require a partial or at least total loss of control over those assets.
Yeah, getting comfortable with the idea of trying to save on estate taxes, but giving up control of something, maybe not having full flexibility to do what you want is a big hurdle. Meeting with estate planning attorneys, meeting with your tax advisor. The closer we get to the end of 2025, the more and more all of the key players in those decisions and evaluations are going to be busier and committed and less available to provide their insights about what makes sense for you and your family. So as time goes on, even just having the discussions about whether you should or want to do something will be compressed and constrained and harder to execute. So anyone who is a high net worth individual or kind of expects to be in the near term based on a liquidity event, a business sale, a business valuation, even an inheritance coming from someone else coming into your household should have that on the table because it is potentially a use it or lose it option. It could be a once in a lifetime type of opportunity.
Yeah, don't be that person who calls your team in December of 2025 and says, we have to get a whole bunch of stuff done by the end of the year. They may not answer the phone. We will, but the estate planner that you're working with may not.
I expect that, barring some dramatic, proactive legislative changes before the end of 2025, I think a lot of attorneys and accountants and appraisers are going to post some sort of best efforts, final day notice to clients because, otherwise, they'll be bombarded with requests and we'll have to deny things. So I think likely see that in a year or so.
We've faced this before, Ed. I think it was 2012 where the exemption amount potentially was going to drop substantially, and a lot of people did gift away assets or take advantage of some of these estate planning techniques you mentioned, and the exemption amount didn't go down. So, it's a little bit of that's what might drive people to wait until the last minute to see if something changes in terms of the legislative path. So maybe if you can at a high level, what are the downsides to doing this planning and then the exemption amount not dropping? Like, what do you lose if you kind of try to get ahead of it and you ultimately didn't need to?
Yeah, well, we mentioned that you might lose some control that you didn't otherwise have to. Often when you structure, a gift or a transfer for estate tax purposes, you might lose some of the ability to be the person in charge. There could be the upfront costs, right? If you're working with a qualified estate planner and other advisors or doing an appraisal, there's the fees that you might pay to do that hindsight 2020, if you didn't need to, it might seem like you absorbed a fee that was unnecessary. There could be, other issues that you have to face when it comes to the way estate taxes and income taxes work together. Sometimes trying to reduce one increases the other and vice versa. So that's kind of a trade-off. So I do think it's kind of personal conversation for everyone based on exactly what the makeup of their balance sheet looks like, really what their goals are, and what their planning projections that we put together suggest they have for the future. And some people will see that there's a clear kind of pro-con trade-off and make a decision based on that. For other people, it will be, more challenging. But it is going to be a very much case by case type of decision. The problem that we're alluding to is if you wait too long or you don't think about it and plan for it, you won't know how to evaluate whether to do it or not in the first place. So it's really just like taking the first leap. You have to say, I don't know if I'm going to, I just want to explore what my options are. And that's the step that people should be taking now if they haven't already, if they're high net worth individuals and have a goal of minimizing estate taxes so that they can continue to grow wealth for their family and the next generations and not have some of that wealth transferred to the Fed for estate taxes. You don't know what you don't know is kind of what where it lands in looking at this type of planning.
Yeah, and you raise a great point there. These decisions need to be made, I think, collectively with your entire team. You can't just look at the estate tax implications. You can't look at the income tax implications by themselves. And you definitely shouldn't be doing it without looking at the lens of your financial plan. Our financial planning software should be able to and does give you an income tax, an estate tax, but an overall net worth enhancement or reduction look at things. And oftentimes, if you're just talking to one of those three groups, you may just get an incomplete or a different answer. It's definitely best approached with your entire team on board.
Yeah, we had a very interesting case in point with that earlier this year with a client. Very young client, very successful, likely to experience a major liquidity event with part of a company that they work for and owned that would be tens of millions of dollars, and really wanted to establish some trusts to set up funds for estate tax savings and transfer wealth to their minor children for the rest of the lives of their minor children, with protections for them and safety from creditors and from future divorce and lawsuits. And the plan that was initially proposed to them just for estate planning transferred so much for the benefit of their children outside of their estate that in the very long term, the resources that were left for this young couple actually depleted because they had moved so much of their current wealth and future growth outside the estate. It looked amazing from an estate tax calculation, but actually might have been harmful to the longevity of their own financial plan. So they really had to evaluate that kind of seesaw of, taking advantage of one thing, but not shooting yourself in the foot on the other side for a decision that's irrevocable. And I do think that's where we play a very good role in balancing different goals and objectives.
Absolutely. And I think you raise another great point there, which is people are already doing this planning. They're not waiting until 2025. We work with a lot of clients whose, size of their potential estate, their net worth has triggered them to get ahead of this because, doing it earlier, I think you're not rushed. You can be more thoughtful about it. You can move some of the future appreciation of those assets that you're quote unquote giving away off of your estate and onto the next gen that's going to ultimately, or the next generations or whatever entities ultimately going to receive the benefit of those assets. So people are doing the planning now. They've been doing the planning. They're not waiting until 2025. And I think that's tremendous. And our thought on that would be, work with an estate planner, rope your tax preparer in, your tax planner in, and put it through the lens of your financial plan. whoever's doing that plan for you, so that you can take a holistic view of the topic.
Yeah, and we're talking about this with the lens of the possibility that the federal estate tax exemption gets cut in half in about 18 months. But something else that's worth mentioning is, we're talking about how the volume of activity around sunset might burden professional advisors, the appraisers, the accountants, the estate tax specialists. Even if you're not likely to ever have a federal estate tax issue, if there's other reasons to be doing more advanced planning around gifting and setting up trusts for heirs and getting value out of illiquid assets, if that planning is something that's important to you now, but you're delaying it or have delayed it, those same people who are going to be working with the federal estate tax issue people are going to be busy then, and they might be hard to reach for your planning needs at that same time, even if you're doing it for a different reason. Maybe you're doing it for state estate tax planning. Maybe you're doing it for the timing of a liquidity event for a business. So I'd almost argue that anyone that might have a goal around wealth transfer, even if you're not likely to be impacted by the sunset, if there's things you need to do to get your ducks in a row with your balance sheet and your plan and your professional advisors, it might be advisable to get that plan rolling, because of the fact that there could be so much going on in a year and a half that you wouldn't be able to do it, even if it isn't the sunset itself that's driving you to do it.
Absolutely. Any other thoughts on either the income or the estate tax potential changes that you want to get across to our listeners?
I'd go back to the idea that now's a really good time to understand your personal tax situation better, to be informed going forward. What is really constructive about my tax planning? What's benefiting me? Where am I getting hurt? Is it related to the type of assets that you have? Is it related to how you're compensated for your work? Is it related to your retirement plan structure? Everyone has a few different things that come into play together, where when we look at a tax return and we look at someone's financial plan, we can get a sense as planners from our kind of experience and just envisioning the path of things, what might work out for someone and where things could use improvement. So now's a good time to have those conversations if you haven't already. And, a firm like ours, like Heritage, we have software, as you mentioned, that can do good projections. It gives us a roadmap. We should anticipate that tax law, is always changing and evolving, and new tweaks to it, but we at least have a good baseline to try to see where we can make some improvements. So it's almost analysis paralysis to go through every single part of the Tax Cut and Jobs Act, especially since we don't know what else is on the legislative horizon for the next few years. But I do think it's worth the exercise of just understanding your own situation better to be prepared.
Great advice, Ed. We'll leave it at that. I really appreciate you taking the time and educating our listeners on a topic that I think we're going to have to revisit over time, over the next 18 months, through our content and the podcast, our blog posts, resources on the website. So this is the start of the conversation, and I really appreciate you sharing your insights today.
Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.